Hi, my name's Phil. I like to talk about politics, and in this video I'd like to discuss the latest move of billions from the UK to the EU as a result of Brexit, taking the total assets stripped from the UK to well over £1 trillion now. Also a little bit about why it might matter. But first, if you'd like to be notified of daily news and politics, please subscribe to the channel and click the bell notification icon. So, news came out last week that JP Morgan, which is a large global investment bank, was moving over $200 billion from the UK to Germany. I think about $230 billion. It's about 200 billion euros. And it's because of Brexit. They're going to be moving it by the end of this year, by the end of the transition period. This is in addition to the, trillion plus pounds worth of assets that already moved out of the UK last year, over a year ago, as various financial service operators fled the country ahead of the initial Brexit date of last March, when they thought that we might be leaving the EU then, and that we might have been leaving it under a no-deal scenario. And that's just what we knew about. To put it into context, before the referendum, it seemed that we had about £8 trillion worth of assets held in the UK. Now, with the news from JP Morgan, it's certain that just in terms of what I can find, what is known, at least 15% of our assets has left the UK for the EU. And like I say, that's just what we know from the major news from sources that have been tracked. There will be other operators who just quietly moved funds, staff, officers overseas without really being picked up because they were smaller operators or didn't make a big public fuss about it. We know a lot went to Ireland. There was also a fair amount has gone to Luxembourg, France, Germany and the Netherlands. Those are the major beneficiaries of Brexit in terms of financial services. Now, at the time, firms were arguing that they feared a no-deal Brexit. This is back last February, March. And they were acting accordingly. They had to protect themselves against a no-deal Brexit. Now, this was at a time when political observers would have known that an imminent no-deal Brexit was highly unlikely. The Prime Minister at the time, Theresa May, was not at all in favour of it. Her government were not at all in favour of it. And Parliament as a whole was dead against it. Now the situation has changed. Not only do we have a government and Parliament that is at the very least giving the strong impression that they are at least not bothered about a no-deal Brexit. Of course, they all could just be stunning poker players and be crapping their pants at the prospect. But nonetheless, they are giving the impression that they're perfectly comfortable, even delighted with a no-deal Brexit, as well as the political momentum being towards the harder Brexit. In fact, we're headed, unless something changes, towards a harder Brexit than we even thought a no-deal Brexit would be last year. It should therefore come as no surprise that even more investors are shifting operations out of the UK. In the case of JP Morgan, to give you some idea about the shift for them, what it means for them, because billions and trillions are not really numbers that we're equipped to deal with. They're rather large. Now, at the start of this year, JP Morgan held 44 billion euros in Germany. That was their stake in Germany. That did not make them a major player in the German financial market. They are now shifting 200 billion euros from the UK to Germany. That would mean that they will increase their assets in Germany by over 550%. So this isn't just a major move for the UK, but also for Germany, because that now does make them a major player. And you can imagine what this has meant for those other financial centres that have had assets moved towards them from London as well. The reports are that this move will essentially double the value of assets held by German branches of foreign banks in Germany. And this is the thing about Brexit. The dwindling numbers of supporters keep trying to ask me to name something good about it. Come on, Phil, they say. It's one thing to say that you don't agree with Brexit, but for the sake of balance, shouldn't you consider the good as well as the bad and come to a reasoned argument there? But the only good for people is outside of the UK. Sure, Brexit is going to be damaging to some businesses in France, Germany, the Netherlands, and especially Ireland as well. But they also get some smooth with that rough. They are seeing their financial centres swelling with what used to be a piece of London. The good to balance the bad of Brexit is entirely outland. And what will London do to try and compensate for businesses moving overseas? What can they do? Surely all they can do is try and push for greater capacity to trade in dirty money. The reason why Boris Johnson and Dominic Cummings want to deregulate our banking sector completely. In the UK, our financial services sector is worth about 7% of our total economic output. Not quite sure what that's going to settle to after Brexit. Now, and that's according to the House of Commons Library. It also contributes 3% of all our jobs. Now, when you bear, and that's just by number of jobs, when you consider that jobs in the financial services sector tend to be significantly above the national average, at least a third greater than the national average wage. Any permanent loss of jobs is not only a blow to economic output, but it also drags down the average wage, because if you get rid of a load of jobs that are paid above average, your national average goes down. And that, of course, has the indirect effect of suppressing wages elsewhere as well, because companies might like to say they pay above average. Well, that average is going to come down, so to make that claim, you don't have to pay as much. And it also has a significant knock-on effect for tax receipts, because in an industry with above average pay, the people being moved overseas will be amongst the highly paid even for that sector. And the Financial Times was reporting again early on last year that would be a hit to the exchequer of at least £600 million. Now, even at the time, it was believed that the real figure would be much higher. That was a conservative estimate, as they put it. With our trajectory being towards a really hard Brexit, that will have to increase even more. We'll be caught in a pincer of lower public funding due to a combination of wasteful Conservative government borrowing, because that debt has to be serviced, and lower tax receipts due to a combination of lower taxes, but also fewer jobs, particularly the higher paid jobs, skilled jobs. And, you know, where are we going to be then? They're going to be cutting even more public services, putting even more people into poverty. And this is all business permanently lost to us. There's no way of recovering this now. You know, even had we not given Boris Johnson that general election, and had Parliament then gone down the road of another referendum, which was then very likely at that point, which would have reversed the Brexit decision, even government ministers accept that. All of that was business that could never have been moved back, because once it's moved, it's not going to move back. Why would it? The reason so much business was centred in London, the reason why London became such a huge financial hub, because that's where, you know, half of the UK's financial services operate from. That's because that's where everyone else was. You know, it's like the formation of a solar system, really. You know, matter coalesces around the largest mass in the region. And as soon as officers move away, that diminishes London. And as more and more moves away, it diminishes it still further. There'll come a point where the largest financial hub in Europe won't be in London, be somewhere else. And then that will accelerate the decline of London. And with Boris Johnson's particular interpretation of Brexit hitting financial services hard, and other sectors of our economy obviously being adversely impacted as well as the severe downturn due to COVID, you know, we are going to be looking at a major contraction of the economy, and it's very, very difficult to see where areas of growth will be, which is why, of course, when I was discussing yesterday, when we're talking about economic forecasts, and although they talk about maybe in 20 years' time stabilising, there is no getting back to where we should be, because to do that, you'd need parts of the economy to achieve growth. Well, what parts of the economy are going to achieve growth after Brexit? That is not clear. But anyway, there we go. Those are my thoughts. Let me know yours in the comments below. Hope you found the video interesting. If you did, don't forget to click the like button. If you'd like to support the channel further, please also click the Patreon link for details. And until next time, I'll see you later.